Hello and welcome back to our next session. In this session, our topic of discussion will be capital. Here, we will find out what the term capital means, the different types of capital needed in businesses, and how to forecast required capital for a business. You may remember from an earlier session where we discussed the 4C plus E framework. Capital is the fourth C. It is defined as the amount of money needed to start, run, and grow a business. For any business, there are two types of activities for which capital is required. The first type of activity is to buy productive assets like machines, land, building, etc. Money needed for this is called fixed capital. The second set of activities are day-to-day ones, such as buying raw materials, paying wages, paying electricity bills, etc. The money needed to take care of such activities is called working capital. Let's understand this through an example of a tea shop that is being started by Ramu. For starting the business, Ramu will need to buy utensils, gas stove, a push cart, chairs and tables for customers, and so on. Money that Ramu needs to buy these assets will be fixed capital for his business. To run the business every day, Ramu will need to buy raw materials required to make tea, such as milk, sugar, tea powder, etc. He will also have to pay for the gas cylinder, pay salaries to himself and to his helper, etc. Money needed to pay for such activities is the working capital of Ramu's business. Every entrepreneur, before starting a business, needs to forecast how much fixed capital and how much working capital will be needed by the business. But even existing businesses, the entrepreneur needs to forecast both of these to run the business well as to grow it further. Let's see how an entrepreneur should forecast both types of capital required for a business. Let's begin with the fixed capital. To help with this, recall the second C of the 4C plus E framework, which is capabilities. Capabilities include equipment, skills, and time available to be spent on the business. Out of these three things, equipment is directly connected to the required fixed capital. But what is interesting is that the nature of the capital changes based on the decision made by the entrepreneur about the equipment. In our example, if Ramu decides to buy tables and chairs, then the money he needs to spend is fixed capital. But instead, if he decides to rent these, then the monthly rental charges will be the working capital. Other than equipment, a business may have to pay for other one-time items. Money needed for these should also be included while estimating the required fixed capital. In Ramu's case, if he rents furniture, the owner of that furniture may ask Ramu to keep a safety deposit. Ramu may also have to buy food license to start his business. Money needed to take care of these things will be a part of required fixed capital for Ramu's business. The two other parts of capabilities, skills, and time available to be spent on the business do not usually have much influence on required fixed capital. But sometimes, lack of required skills may require an entrepreneur to attend some training, such as beautician's course. In such cases, fees paid for such trainings should be included in the required fixed capital. Now that we have seen how to forecast required fixed capital, let us find out how to forecast required working capital. For this, we need to understand for what duration we are estimating the required working capital. Is it for a day, or for a week, or for a month? For most businesses, we consider 1 month, but it could be much shorter for certain businesses. For example, in a vegetable selling business, This is likely to be one day because of constant buying and selling activities in such a business. For seasonal businesses, the period and the approach both are different, and hence we will discuss forecasting working capital of seasonal businesses in a separate session. Required working capital for a period mainly depends on 4 factors. The first is the level of the inventory the business needs to keep for that period. The higher the inventory that a business has to carry, more is the required working capital. This factor is very relevant for production and trading businesses, but not so much for service businesses. The next factor is direct and indirect costs that a business has to pay during the period. These include money paid for wages, rent, salaries, phone bills, electricity bills, and interest on loans. More the costs, more is the required working capital. Let's assume that somebody in Ramu's family is severely sick. Ramu will then need to spend more time at home every day. Hence, he will have to hire another helper for the business. This will increase the salary cost and hence will increase the required working capital. The third factor is the credit extended by the business to its customers. If more amount of credit is given for a longer period of time to the customers, then more is the required working capital. Let's go back to Ramu's business to understand this point. A school buys a lot of snacks and tea from Ramu for their annual day function, but they will pay only after 2 weeks. This means even if Ramu has good revenues from the school, he has received no cash from it during the period. Hence, the business needs to spend its own cash to buy raw material, to pay the helper, etc. until the school pays the bill. This amount will increase the required working capital. The fourth factor is the credit given by suppliers to the business. If more credit for a longer period is received by the business from its suppliers, then lesser is the required working capital. Once again, we will return to Ramu's business to understand this point better. Ramu has brought tea powder, sugar, spices, and flour for the whole month. The grocery shop has allowed him to pay the amount after 2 weeks. So, Ramu will be able to use the cash from the revenues in this period to easily take care of other costs such as helper salary and gas cylinder bill. This will reduce the required working capital for his business. All of these factors are reflected fairly accurately in cash flow statement. In a monthly cash flow statement for a business, the shortfall between recurring cash inflows and recurring cash outflows is roughly equal to the required working capital for the month. Hence, ideally, every entrepreneur should look at previous month's cash flow statement to forecast how much working capital is required in the business for the coming months. So, it is important for an entrepreneur to prepare a correct cash flow statement before calculating required working capital for a period. But let's also keep an important point in mind. It is possible that there are such large cash outflows expected in the next period which were not there in the previous period. In such a case, the entrepreneur should not rely only on the previous period's cash flow statement. She needs to anticipate large cash outflows as well as inflows in the coming period to be able to forecast required working capital reasonably accurately. Based on the 4 factors we discussed, we can create a formula that helps an entrepreneur forecast required working capital. Let's look at the formula first, and then we will look at each term of the formula and how it is connected with other terms in the formula. We define required working capital for a period equal to forecasted recurring cash outflow for the period minus forecasted recurring cash inflow for the period minus opening cash balance for the period minus last period's accounts receivable to be collected in the period plus last period's accounts payable to be paid in the period. The formula uses 5 terms. The first is forecasted recurring cash outflow for the period. This is the amount that the business is expected to pay out, and hence it becomes required working capital for the period. The second term is forecasted recurring cash inflow. This is the amount that the business is expecting to come in, and the required working capital for the period reduces by this amount. So, we subtract the second term. The business will begin the period with some leftover cash from the previous period. This further helps reduce the required working capital. So, we subtract the third term, which is opening cash balance for this period. The fourth term is last period's accounts receivable to be collected in the period. This also helps reduce required working capital, as the money owed by the customers during the previous period is expected to come into the business in the period. So, we subtract the term also. Finally, the fifth term is last period's accounts payable to be paid in the period. It is referring to the money that the business has to pay to suppliers for the raw material it brought during previous period. This increases the required working capital, and hence we add this term. That, in a nutshell, is the explanation of the formula. Let's now summarize the main points which we discussed in this session. We define capital as the money required to start, run, and grow a business. Capital is of 2 types: fixed capital and working capital. Fixed capital helps take care of one-time things in setting up a business, and working capital helps in running the business on a daily basis. The required fixed capital in a business depends mainly on capabilities. The required working capital depends on 4 factors. These are level of inventory, costs, credit given and credit taken. Finally, we looked at a formula which uses these 4 factors. The formula helps an entrepreneur calculate the required working capital for a period. That was the overview of capital.